All opinions expressed by the program participants are their own and do not reflect those of Blue Line Futures LLC or their affiliates. The content is for informational purposes only and should not be taken as trading advice. Futures trading involves a substantial risk of loss and may not be suitable for all investors. Therefore, carefully consider whether such trading is suitable for your financial condition. Hi, everybody. Welcome to episode 9 of the Macro Corner podcast, proudly presented by Blue Line Futures. I'm your host, Paul Wankmuller. The Macro Corner chart book is available in the description of the podcast on bluelinefeatures.com, as well as attached to the email sent to clients every Sunday. Not a client? Reach out to info@bluelinefeatures.com for a free trial. My guest today is Giannis Mindall. The topic of today's podcast is the reality of negative real rates. Welcome to the show, Giannis.
Hey, Paul, thanks so much for having me back on the podcast. I'm really excited to cover the topic today, so let's get right into it.
Yeah, absolutely. So when we talk about interest rates, we were looking at the federal funds rate. We're thinking about inflation as well. So what does the term real negative rate interest rates mean?
Yes, so exactly. So when we talk about interest rates, we basically talk about two types of rates. On the one hand, you have nominal interest rates, which is basically what you see on your screen, say the federal funds rate that you just talked about. Then you have 10-year treasury yields, you have 5-year treasury yields, and the real rates are basically those nominal yields minus inflation. The Fed also uses different sorts of measures to sort of see where real rates are, but after all, we really need to look at inflation on the one hand, nominal rates on the other hand, and then in the middle, that's where real rates are. So nominal minus inflation.
Okay, that makes sense. Are there any other factors that you would say that go into, is it just inflation, or are there other factors as well that would determine this real rate, for lack of a better word?
So, I mean, it's really just nominal and inflation.
Mm-hmm.
I mean, you can look at nominal yields and assess whether there are different sorts of economic indicators and effects, pulls and push effects that flow into the nominal rate, and basically where treasury yields are guiding the Fed towards and what those effects are. But just in terms of looking at the pure number, it's really just those two factors. What flows into each of those factors is a completely different question, of course, and that's a different answer in that regard. But yeah, it's when we look at real rates, it's nominal and inflation.
So if you know these interest rates, that is the United States government borrowing money from its citizens, from different people around the world, in order to continue to function as a country. So at some point, they have to make interest payments to pay for all the things that we need. So if you're looking at, let's say, our net debt, I guess, right? Or, the amount of money that they're borrowing, and you compare that to GDP, what does that story tell us?
So when you look at those two factors, on the one hand, you have the government debt, as you said, that's just used to finance all sorts of fiscal initiatives, whether you look at Social Security, the military, things like that. And then on the other hand, you have GDP, which is basically a measure for how much a nation produces and what is the value of those end products, of those finished products. Right. And that story basically tells us that over the years, debt has exponentially grown almost, and GDP has just not kept up with that pace of debt growth. And then you have to sort of ask yourself how that debt gets repaid at some point. I mean, when you look at the government like an individual or like a company, then ultimately the financial health of the institution is a result of how much revenue the institution makes versus how much cost the institution has. And what we have basically seen is we've had a lot more costs than revenues, such as tax receipts, things like, or corporate receipts, things like that. And so as that measure sort of went vertical in a lot of ways, and is projected to go to 180+% by the year 2052, I want to say it is what the Congressional Budget Office said. As that debt pile continues to grow as a result of all these initiatives from the fiscal side, one has to ask how that issue ultimately gets resolved, because the soundness of the U.S. government and the treasuries associated with the U.S. are ultimately subject to factors like that and the faith that investors have in the treasury.
So if the word inflation has been on everyone's tongue for the past year, especially, but throughout history, we've seen it in the 1980s. We've seen it recede. We've seen it grow. But if I'm thinking correctly, if inflation affects the value of the dollar, and the government needs to pay back this debt with interest payments, does the government actually want some inflation so that they pay these bills back with a dollar that is worth less?
That's exactly where sort of the topic of yesterday's article comes in, and what we're going to talk about here today is whether it's actually somewhat of a strategy to have the rate of inflation above the level of interest rate that the Federal Reserve sets. Why is that? Because, as you said, as inflation stays elevated and the interest rates that the government has to pay on the debt that it owes, that means that it can repay those liabilities with money that's worth less, while GDP keeps growing. Nominal GDP keeps growing at that elevated rate, because ultimately, if money is worth less, then
Right.
the liabilities are worth less, but also the things that you produce and ultimately measure in dollars, that number keeps growing too.
Right.
So
Right.
one strategy that, for instance, the UK employed or deployed sort of after World War II was they had an extremely high debt burden, which means that the ratio of debt to GDP was really high.
Mm-hmm.
And the way out of that situation, the way out of the potential that there is a loss of faith in the British pound and the governmental institutions as a whole, was basically for them to leave inflation relatively high compared to the interest rate that the Bank of England and the UK sets, and therefore bring down that ratio of debt to GDP. So yes, the answer is ultimately that it's somewhat of a strategy, and that's also why the Fed sees deflationary dynamics as much more threatening than inflationary dynamics. It's
Right.
all about the soundness of the institutions and the institution's ability to repay what they owe. So that's ultimately why high levels of inflation might not be all that bad in the eyes of the Fed. And that's ultimately why a lot of people also show misunderstanding, because after all, it's really bad, especially for the lower income deciles. But just from the government perspective, it's not that bad of a thing, really, if you think
Right.
of the fact that these debt level projections are going nowhere but up, and somehow that issue has to get resolved. And behind closed doors, that's probably a main point of discussion.
I do believe I think we had a Fed meeting last week, Jerome Powell, and I think that 2.5% is going to be the neutral rate that they're looking for going forward.
Yeah, so that was another sort of really, really interesting aspect of the press conference that was extremely dovish leaning. I mean, we first had the Fed policy statement come out, and the first sentence was that spending has slowed and that there are factors in the economy that show progress, because what they want to do is they want to slow spending. That's the goal of monetary policy right now.
Right.
Jay Powell officially said on a central bankers panel, and not only there, but on multiple other occasions, that there is a job to be done on spending. So they assess progress of what they're currently doing. Progress of, I mean, QT is expected to kick in at a much higher rate, but
Right.
progress of monetary policy with spending levels. If spending levels come down, if the economy cools, that means the effects of tighter monetary policy are seen in the economy. And as you just alluded to, he made a really dovish comment, which is that he sees the federal funds rate, the lower bound of that funds rate, as a 2.25, and the upper bound is a 2.5. It's sort of a range.
Yep.
And he stated that they basically think that right now we are at the neutral rate, which is extremely concerning on the one hand, promising on the other hand. For both, it depends on which camp you're in. But the fact that they're stating that right now he thinks we're at the neutral rate while we have inflation running this hot is a bold statement to make. And the
Right.
neutral rate is basically defined as 0.5% real nominal yields over the long term. So that was basically be the assumption that long-term inflation expectations remain at 2%. And because we are at 2.5, we are at that neutral rate where the real interest rate is at 50 basis points. And that's
Okay.
what he's speaking to. So he's taken the current rate and is subtracting the long-term average inflation target 2% and is defining the current state as the neutral rate. I mean, Larry Summers came out and was basically critiquing it in a harsh manner, which I think is deserved in that instance, because to tout the current federal funds rate at 2.25% to 2.5% as neutral when inflation is running as high,
Right.
they are making the assumption that inflation is ultimately going to return to 2%. Whether that's going to happen, nobody really knows. But regardless, they're making that extremely bold statement.
Oh, that's great. That's great. Larry Summers, Treasury Secretary from the late 1990s, I believe, right?
Exactly. So Larry Summers was the Treasury Secretary from 1999 to 2001, and he's commonly regarded as an economist that a lot of people listen to. So he came out on the back of this really dovish press conference and said what a lot of people were already thinking, which is we're not 2.5% is not really the neutral rate when you consider
Right.
where inflation is at right now. So
Right.
that's
Right.
it was good to hear that and just sort of correct. I mean, I expect the Fed to sort of move maybe a little closer to what Larry Summers' opinion is on that over time. But, ultimately, if monetary policy is a communication exercise and they were maybe sort of trying to the waters in that regard. But yeah, to tout the neutral rate as 2.5 is highly questionable in the current environment.
Right. And then I think going forward, what Jerome Powell was saying is, which was very different in this meeting versus previous ones, that they're going to be relying on data dependence.
Yes, so that was one of the main aspects of this entire Fed policy decision day and the press conference that followed the decision, which was they are not going to give the same type of guidance that they used to give in the recent past, which is we're going to move at this rate, we're going to implement QT at this pace, and QT we know when it's supposed to kick in. It's really interesting that those settlements of treasuries and mortgage-backed securities have not really followed through as one would have expected, given that they announced that they had already tapered off. But that's an entirely different set of questions we need to ultimately end up answering. But yeah, he basically abandoned forward guidance, and that was seen as another dovish aspect to this entire press conference, because if they don't give forward guidance to the degree that they used to, they are basically saying we're moving closer to where we ultimately going to end up. I mean, I think they'll ultimately end up at 3.25, 3.4 ish on the federal funds rate. That's what they're currently projecting. And what they're saying is on the way to that place, which we're not that far away from anyways,
Right.
we are not going to give you that same sort of setting up expectations. And we believe that we're ultimately moving closer to a point where we don't need to be as aggressive anymore. And I mean, one of the goals of implementing forward guidance and moving along those lines was we want to give a clear market signal that we're going to be committed to fighting inflation. And they are basically saying right now, we think that economic indicators such as the labor market as well as spending are moving in our direction. We also think that inflation is going to cool off, and therefore we don't need to send as aggressive of a signal going forward.
Sure. Now, speaking of all that, another word that is on the tip of everybody's tongues these days is recession.
And what I'm looking at here, this is in our chart book, but the National Financial Conditions Index. Now, with inflation as high as it is right now, and prices for gasoline inflated as well for the everyday person, a lot of people are talking about whether we will see a recession, whether job hirings will go down, and things like that. But what is the National Financial Conditions Index, Giannis?
So the National Financial Conditions Index, which is also included in the chart book that people can access, is a combination of 105 different parameters of financial activity, and
Okay.
putting those 105 parameters into one, or in this case, four different numbers. So you have the financial conditions index itself, you have risk, you have credit, and you have leverage.
Okay.
So so the NFCI is just the combination of all of them and the end number, and then you have risk, which is just a measure of how much volatility there is in the markets and how much funding risk there is, meaning is there a lot of loss expected on high yield products, what is the state of investment grade credit, things like that. Then you
Mhm.
have the credit indicator, which basically looks at conditions of households and corporations, and then you have the leverage indicator, which measures the debt to equity, which is another. This is basically what debt to GDP on the macro national level, on the federal level measures, and the same thing applies to households and corporations.
Okay.
So you have the National Financial Conditions Index still at a negative number, which is seen to be so you have contracting, and then you have sort of expansionary financial conditions. And a negative number on the National Financial Conditions Index means that conditions are still favorable. So
Okay.
we are not yet in restrictive financial territory in terms of how monetary policy gets set. It's not yet restrictive. And this is the reason why this is interesting, is because Jay Powell made a note during the press conference where he said that they expect to move into moderately restrictive territory as far as financial conditions are concerned. So the fact that we're not yet at that place doesn't mean this number is going to flip positive all of a sudden, and we are officially, as measured by this index, in restrictive in a restrictive sort of environment. But it does mean that he thinks that we need to move a little closer towards that place. And the NFCI is just a measure of how
Okay.
restrictive credit and monetary policy affecting credit is.
No, is that created by the National Bureau of Economic Research?
This is an indicator published by the Chicago Fed. I mean,
Okay.
they started publishing this indicator, and that's just a widely followed number. I mean, another indicator that we've also used in the past would be that Goldman Sachs Financial Conditions Index. Ultimately, there are a lot of different indicators that measure the degree to
Gotcha.
which policy tightens financial conditions. But this is just another one.
Okay. Oh, thank you for that. So, speaking of Goldman Sachs, I saw recently in a note that they talked about the fear of materially underperforming. I think that it's really interesting. Being in finance for as long as I have, you do want to perform your best, but in addition, you still have to kind of outpace your colleagues, your competitors, and across the board in order to remain relevant to your customers.
Yeah. So what has been widely referred to in finance in general has been FOMO, the
Yep.
fear of missing out.
Yep.
And Goldman took that and turned it into FOMO, which is the fear of materially underperforming. And this is important because if you get to a place where sentiment in the market is extremely negative, and suddenly the market turns around, then a lot of people start to chase because they cannot afford to underperform the benchmark or their competitors. And this is just a concept they introduced. And looking at how quick a rally, but also a sell off could happen, because a lot of these funds, they did underperform leading up to this event where you had, as tech stocks crashed, a lot of the more forward-looking sort of lottery tickets got
Right.
devalued in the process of rising rates. And as people see the index rise, they have a need to chase because they have underperformed and they're sort of trying to make up for that underperformance. That ultimately leads to money flows. And that's just, it's not a thing that you can necessarily quantify, but it is definitely a thing that is in the minds of investors and those people who manage money, because ultimately you get compared against someone, and what matters is your relative performance.
Of course, it's interesting. I do recall that most endowment funds, especially the ones at certain Ivy League schools, consistently underperform the market. Consistently.
Yeah, I mean, I'm not too well versed on the endowment side, but one of the things that is interesting and that I can speak to is you have these endowment funds who've invested in a lot of illiquid asset or illiquid
That makes sense.
financial assets, which would be the alternatives such as venture capital, where you invest in private companies, and those companies don't necessarily get more mark to market on a daily basis the same way Apple stock would. So when you own Apple stock, you can see on a daily basis, this is
Right.
where my account is at, and this is my current financial state. But with private investments, that's not the case, because if you run a private company, you don't necessarily assess the value of the company on a daily basis. You don't have an auditor or a consulting firm come in and value what your company is worth, or a private deal doesn't happen on a daily basis. And it's sort of only at those points where that private investment gets measured that the book ultimately gets marked to that number. And
Right.
as that process unfolds, you see that private investments always lack the public investments, and the ultimate end taker of what is getting valued at where is the public market. So in reality, some of those books will probably be a lot lower than the official numbers suggest. And
Right.
that's ultimately also going to affect how many scholarships these schools can give and things like that. I mean, all those things take time to work themselves through the system.
Sure. Let's switch gears here a little bit. So, speaking of broader macro forces, one thing at the end of the day that is, it's more expensive for companies, but it's also what enables citizens to purchase things is wages. Now, we have a great chart here in the chart book. I believe it's page 4 and 5. But basically, what you're telling me is that when inflation kicks in, or when wages rise, the lower end of the curve, meaning high school or lower, actually increases the most versus people that say have a bachelor's or an MBA or further. And I'd love to know why.
So in the recent past, or call it the last 2 decades or so,
Mm-hmm.
we have seen a financialization of the economy, which means, um, bankers, people in the financial industry, and
Technology. Yeah.
also people in the higher on the higher end of the income spectrum. Those have been the wages that got raised the most, and we've basically seen a flip of that starting in at the beginning of last year, call it.
Okay.
And the reason why that's happened is, first, you have people dropping out of the labor force. Globally, you have an undersupply of blue collar labor, which
Mm-hmm.
means if you don't have enough supply but the same degree of demand, then prices adjust. That's how a market works. And as those wages move up, it may as well be a more secular driver of inflation, especially as companies look to relocate from areas like China as their supply chains become, or already have become, less reliable.
Mm-hmm.
And you right now see that blue collar labor is in undersupply, and that's why the wages have to adjust. And this is one factor that may be underpriced by the market possibly. But yeah, we've basically seen this flip. We've seen over the last 20 years or so that it was really a financialization. You had Wall Street versus Main Street, and it's always been sort of this thing that people talked about where you had Wall Street winning, but maybe Main Street not so much. Maybe that's flipping sort of, and the return on capital that labor makes may be a bit more than the return on capital that capital makes. And
Right. And I think something very important to state is that, just because the term is blue collar does not mean that it's less skilled. I grew up working with my father, and I'll tell you this much. I've seen a lot of people work on their own houses that we were paid to fix their mistakes. It's not always the easiest thing in the world to install plumbing, electric as well, roofing, but at the end of the day, you need all those things, don't you?
Yeah, exactly. I mean, I know a lot of people, family and friends who are in these industries where you have massive undersupply of labor. I mean, there are a lot of people building houses, and we've sort of seen this housing boom coming out of COVID as people want to work from home. But then someone, of course, needs to build all the things that go into a house, and those tend not to be college degree type labor, which means and also you have to think of one aspect, which is what is popular at any given point, and we've of
Right.
course seen this shift to technology, and what kid goes to school and suddenly aspires to be, say, a carpenter. I mean, as you said, that's not meant to be disrespectful in any
Right.
way,
No,
shape,
no,
or
of
form.
course. Yeah.
That just means that's the state of society, and if there's an undersupply of labor in the things that people want, then it means the price has to go up, and it's quite interesting to see this flip, especially as maybe the world becomes a little bit less centralized as it pertains to the manufacturing of goods.
Sure. I mean, it's interesting as well that in my high school, I went to public school. We had an auto shop, including car lifts. We had a metal shop. We had a wood shop. And I believe about 5 years after I graduated, they gutted everything because they were afraid that kids were going to get hurt. But guess what? There you go. There is so many less kids that are even exposed to it. Not saying that you have to go into those fields, but you can at least give it a shot and try it. But yeah, it's just like I think it's what you said. It's trends. I believe that in the United States, especially, you are pushed, to go to higher education. I can't recall any of my teachers or guidance counselors even recommending or even asking, hey, do you like to do these things? Or, what do you think about owning your own shop or owning your own business with regards to that? But I mean, based on these charts, it looks like it's a pretty good business to be in.
Exactly. I mean, this is all goes back to sort of what part of the output equation benefits, and you have, on the one hand, you have labor, on the other hand, you
Right.
have the people who own capital, and maybe
Yep.
there's somewhat of a flip as far as income goes. So yeah.
Great. What is how do the federal funds rate and bank credit go hand in hand, especially with regards to loan growth year over year? I do see a spike. I know this is we do have this on page 6 of our chart book, but what is the relationship between the two?
Yeah, so you have the federal funds rate, which is sort of seen as this benchmark for bank credit for loans that banks hand out, and the rate that they charge. So as
Right.
the federal funds rate moves up, you naturally expect less demand for credit that's more expensive. And you see that in multiple instances. There has been this precedent where you had the federal funds rate move up, and loans and bank credit is expanded regardless. But then also there's sort of a tipping point where you have the economy slow as a result of more restrictive monetary policy conditions, and at that point, loans and bank credit tip over. So the question really becomes is when is that tipping point going to happen, and when is that going to translate into slower economic growth? I mean, of course, we have seen 2 consecutive quarters of negative GDP growth.
Yes.
I mean, we're debating a lot about what is actually a recession these days.
Yeah.
But,
Yeah. I think everybody is. Yep.
yeah, but regardless, it's you don't necessarily need to know the technical definition of a recession to assess whether the economy is slow or not. I mean, you can measure that by different things. But yeah, I mean, what we're trying to show here is just where is that tipping point going to be, and possibly that tipping point might be sooner, might be later. There's been a lot of talk around maybe there have been some regulations that might have given more incentives to banks handing out credit despite federal funds moving up, but ultimately we'll have to follow the data in that regard, and there's little that we can rely on.
As Jerome Powell said, data dependence going forward. Well, Giannis, that was a great episode. Thank you so much for joining me. This is Giannis Mindall. This has been Macro Corner, proudly presented by Blue Line Futures. The Macro Corner chart book is available in the description of the podcast on bluelinefutures.com, as well as attached to the email sent to clients every Sunday. Not a client? Reach out to info@bluelinefutures.com for a free trial. Thank you very much for joining me today, Giannis. I look forward to seeing you next week.
Likewise on my end. Thanks so much.
Have a great day, everybody.
All opinions expressed by the program participants are their own and do not reflect those of Blue Line Futures LLC or their affiliates. The content is for informational purposes only and should not be taken as trading advice. Futures trading involves a substantial risk of loss and may not be suitable for all investors. Therefore, carefully consider whether such trading is suitable for your financial condition.